liquidity professor. So for today, our presentation will be about the CPT drive and power financial statement analysis. This is our team member, consists of 5. And this is our table of content, which we will cover the company history, analyze the ratio result, vertical analysis, horizontal analysis, and conclusion and recommendation. So first, let's get to know about the company first. So I will be talking about the company history. So the company was founded in the mid-1990s in the headquarters in Bangkok, Thailand, operating in the electrical equipment and power system sector. It specializes in providing reliable power and automation solutions for individual utility infrastructure projects. The company offers a comprehensive range of products, including service, medium and low voltage switchgear panel, drive, motors, and advanced automation system. Its portfolio also covers the power quality improvement, power conversion, energy storage solution, and as well as the substation construction and complete electrical installation services. In addition, the company provides maintenance, commissioning, upgrade, and retrofit services to ensure a long-term system performance. The business is founded and operated by highly experienced electrical engineer and maintain license partnership with leading global technology provider, such as enabling it to deliver a fully integrated end-to-end solution from design and manufacturing to installation after sales support. Moving on to the next part, which is ratio analysis. So for this slide, show the company liquidity performance over the past 6 years. First, looking at the current ratio, we can see a strong improvement from 1.72 in 2022 to 3.88 in 2024, indicating the company is now in much better position to meet its short-term obligation. Next, the collection period has improved significantly. It dropped from a very high level of over 122 days in 2020 and 2021 to around 48 days in 2024, which suggests more effective credit control and faster cash inflow. However, the day to sell inventory increased to 62.15 days in 2024 compared to earlier year. This indicates that inventory is moving slowly, which may tie up cash and affect efficiency. Overall, the company demonstrates a strong and improving liquidity position. Attention should be given to inventory management to maintain optimal cash flow. So this slide highlights the company operating performance through gross operating and net profit margin over the last 6 years. We can see that the company faced significant challenge in 2021 and 2022, where both operating and net profit margin were negative, indicating that operating costs exceed revenue during that period. From 2023 onward, there is a clear recovery in profitability. Gross profit margin increased from 14% in 2023 to 19.2% in 2024, suggesting that improved pricing power or better cost and goal management. Similarly, operating and net profit margin continue to improve in 2024, reflecting a stronger cost control and operational efficiency. Overall, the company demonstrated a strong turnaround in operating performance with margin now exceeding our pre-2022 level. So moving on to this last slide of ratio analysis, this slide shows our asset utilization ratio over the last 6 years also. So first, for account receivable turnover, improved significantly after 2021 and stayed stable in 2023 and 24, which indicate a better credit control and collection efficiency. Second is inventory turnover, show a clear decline compared to 2019 and 2020. This suggests inventory is moving more slowly, which may lead to higher holding costs. Finally, total asset turnover peaked at 2022, but has declined in the last 2 years, indicating that overall assets are generating less revenue. In summary, while receivable management has improved, inventory and overall asset efficiency remain key area important for management.
And now let's move on to the vertical analysis of the statements of financial positions. To the vertical analysis of the statement of financial position, now let's look at the trends of the total current asset from 2019 to 2024. Vertical analysis expresses each line item as a percentage of total asset. We see that our liquidity position has remained relatively stable, fluctuating between 54% and 66%, while there are a dip in 2024 to 50.66%. We have seen a steady recovery over the last 2 years, ending 2024 with current asset representing 63.59% of our total asset base. This is just a healthy buffer of liquid resource to support ongoing operations. Let's look at the cash and cash equivalents. In 2024, cash jumped to 18.43%, nearly doubling from the previous year. This indicates a very strong liquidity position. Conversely, we have become much more efficient in managing our receivable and inventory. Trade receivable dropped from a high of 32.14% in 2020 to just 10.50% in 2024. Similarly, inventory has decreased from 17.49% in 2022 to 9.57% today. This trend is positive. It shows we have collecting cash faster and moving stock more efficiently rather than letting capital sit idle in paid bills or unsold goods. Now let's move on to the current liability. The most striking observation here is the significant reduction in total short-term obligation. In 2022, current liability accounted for 48.25% of our total structure. As of 2024, that has been cut by more than half down to 20.32%. Specifically, trade payable dropped from 34.53% to 13.51% over that same period. This indicates that the company is aggressively deleveraging its short-term debt and is in a much less crowded position regarding its immediate payment obligation. Our provision for product warranty remain negligible and stable at under 2%, showing a consistent product quality. And now let's move on to the equity. There is a clear upward trend in total equity, which has grown from 65.94% in 2022 to 80.73% in 2024. This is a very strong signal of financial health. It means that over 18% of our assets are now funded by shareholders rather than a creditor. Our issue and fully paid up capital stand at 64%, while the premium on common share contribute 41.41%. The fact that our equity ratio is increasing while our liability ratio is decreasing show a strategic shift toward a much more stable, equity-heavy balance sheet. We are becoming less reliant on external borrowing and more self-sufficient. And now let's move on to the non-current assets. Over the last 6 years, the most significant trend is the steady decrease in property, plant, and equipment, which has dropped from roughly 34% of our total asset in 2019 to under 27% in 2024. This suggests a shift toward a leaner, potentially more asset-light operational model. For our total non-current assets, peak in 2022 at over 45%, but has since normalized to 36.4%. This indicates that current assets now make up a larger portion of our balance sheet than they did 2 years ago.
So moving on, we will talk about the statement of profit and loss. And we're going to focus on the vertical analysis of SOPL, which is the cost of sale. And starting with the cost of sale, this remains the largest expense category for the company. In 2024, the cost of sale accounted for 84.55%, which represents an improvement compared to the previous years, such as 89.03% in 2023 and 94.35% in 2021. This declining trend suggests better control over production and service delivery costs. Although cost of sale is still relatively high, the reduction over time has played a key role in improving overall productivity. And for the total expenses, in 2024, total expenses amounted to 135% of the revenue, which is significantly lower than in 2021 and 2022, when the total expenses exceeded over 300% of the revenue. This reflects a clear improvement in the cost management. And if you look at the key components, distribution costs were 8% in 2024, which is slightly higher than 5.86% in 2023, but well below 17.48% in 2019, indicating more efficient selling and distribution activities. And for the administrative costs, stood at 12.88%, remaining stable compared to 2023 and substantially lower than 21% in 2021 and 2022, suggesting improved overhead efficiency. And lastly, for the gain or loss on exchange rate, it had a minimal impact in 2024 at 0.04%, indicating limited exposure to foreign exchange fluctuation. So overall, the reduction in total expenses has been a major contributor to improve operating performance. On to the operating profit or loss. The company shows a strong turnaround. In 2024, operating profit showed a 17.73% in 2024. So in absolute terms, revenue was 973 million baht, while expenses were 884 million baht, resulting in a clear operating surplus. A similar performance was recorded in 2023. With an operating profit of 17.33%, supported by 1,202 million baht in revenue and 1,100 million baht in expenses. In contrast, earlier year shows operating losses driven by expenses exceeding revenue. For example, in 2022, expenses of 1,300 million baht exceeded revenue of 1,300 million baht, while 2021 recorded an even larger loss due to significantly higher expense levels. This demonstrates that recent profitability is largely driven by effective expense control rather than revenue growth alone. And moving on to the profit or loss for the year. Finally, looking at the profit or loss for the year, the company reported a net profit of 14.1800 in 2024 after recognizing an income tax expense of 3.51%. Despite the tax impact, strong operating performance allowed the company to maintain a healthy net margin. In 2023, the profit for the year was 13.72%, with a similar tax expense of 3.55%, showing consistency in both profitability and tax burden. In contrast, during the loss-making years such as 2021 and 2022, the company recognized tax income of 7.81% and 1.22% respectively, which helped reduce losses but was not sufficient to achieve overall profitability.
Now moving on to horizontal analysis, statement of financial position. So cash and cash evaluation increased significantly, indicating strong liability spread, receivable decline, suggestion improved collection. Inventory increased mainly due to the higher stock and advanced payment. Overall, total current assets remained stable over the period. To non-current assets, since our best year in 2019, our total non-current asset base have remained stable, ending 2024 at 102%. However, while the total is standing, the makes our what we own have changed radically. Now moving to balance statement of total percentage. Stability as the core our total assets base have remained remarkably stable over the last 6 years, consistently hovering around the 100% mark relative to our 2019 baseline. Growth, we saw the steady upward trend starting 2021, touching the speed of the approximately 122% in 2022. Gradual corrections following the 2022 paths. There have been a straight line downward collection there 2023 and into 2024. Current standings. As of 2024, our total asset percentage has returned to nearly exactly at same level as our 2019 standing point. Into non-current liabilities. Looking at our total liability performed from 2019 to 2024, we see a story and growth followed by the return baseline after holding strategy in 2020. Our liabilities spikes in 2022 at over 110% of our 2019 level. Since that, we have seen gradual deadline bringing us back to 100% in 2024, the same level we obtained 5 years ago. Now moving to equities. Turning to our equity horizontal analysis, the standout trend is inappropriate. Deficit surging to 706% in 2024 compared to our 2019 best year, while our largest research doubled its growth from the last year to reach 22%. Its overall equity structure showed the significance equity, practically with the sharp increase in retained deficiencies since 2023, indicate appropriate of the substantial financial adjustment for the company.
Now, moving on to statement of profit and loss. Horizontal analysis. Sale and total expense increased significantly after 2020, indicating work cost control. Although there was some drop, costs remained much higher than the best year. Profitability saw a sharp contrast, and the company performed very well in 2021 and 2022, but the reverse. In 2023 and 2024, where both operating profit and overall profit dropped deeply into loss. Overall, despite earlier strong performance, recent expense and outright revenue and recent year, SOPL need better cost management and improve efficiency to restore profitability. So now let's move on to the cost sale pitch in 2022, putting the greatest pressure on gross margin before the easing as cost control and pricing power improve. Total expense as a percentage of revenue were also highest in 2021 to 2022, likely reflecting expansion, inflation, or different project made. From 2022 onward, both cost of sale and total expense ratio improved, helping to the support and stronger profitability in 2023 to 2024. 2024, the company achieved its lower expense ratio and clearly demonstrating operational efficiency gain and more sustainable cost structure. In 2019, we start and lost the position, then moved to the strong profitability by 2021 and 2022, reaching our peak operating performance. However, this growth was not sustainable. Profitability falls sharply after the peak as a recently straight and back toward break-even into the loss gain and some year. The key takeaway is that our operations are not yet stable, and our result is very sensitive and change in cost, demand, and one-off factor which expose the company to significant risk. Going forward, we need to focus on stabilizing core operations, strengthening cost control, and building more predictable revenue stream, and so that disrupt wing and in operating performance are reduced. In conclusion, the company showed a strong financial recovery after loss in 2021 to 2022. Liquidity is very strong in indicating low short-term financial risk, and profitability has improved steadily with a positive ROE and margin in 2023 to 2024. Operating performance is recovering but not yet to peak historical level. Asset utilization has weakened, especially inventory and total asset turnover. For the key mistake, the company is financially stable and profitable but need to improve the asset efficiency to sustain long-term growth. Based on the financial ratio analysis, several recommendations can be made to strengthen the company's future performance. First, inventory management should be improved as a decline in inventory turnover such as slowly stock and movement the higher holding costs. Better the planning and help the free up cash and improve the efficiency. Second, asset utilization should be reviewed and drop the total asset turnover indicate that assets are not being used effectively to generate revenue, so the assets should be optimized or reduced. The company should be continue and strong receivable management and improve the collection efficiency, support stable cash flow, and reduce the credit risk. For excess liquidity should be used more productively, while high liquidity reduce risk, and investing surplus funds can improve the overall return. Fifth, cost control and pricing strategy should be remain a focus to advance and strengthen profit margin. Finally, future capital investments should be carefully evaluated and ensure they contribute positively and efficiency and profitability. Thank you.